Welcome to the educational Zoom series where we explore different topics to gain financial literacy and achieve financial freedom. Today, we will explore the basics of infinite banking with Gary Pinkerton. Hi, Gary. Welcome.
Hey, how are you doing, Diva?
I'm good, thanks.
Pleasure.
Thank you. Thank you for joining us. So, guys, Gary is a wealth strategist. He's a military veteran, entrepreneur, speaker, best-selling author, and a real estate investor. He has degrees in engineering from the U.S. Naval Academy and a master's in nuclear engineering from University of Illinois. He commanded the attack submarine USS Tucson in his 25 years as a naval nuclear submarine officer. Gary has experience designing, owning, and helping others implement high cash value life insurance, real estate, and alternative investments. He's passionate about furthering entrepreneurship and helping American families achieve financial dreams, establish a lasting financial legacy, and reducing taxes. He lives in Florida with his wife, Sue, and their two sons. Gary, welcome. Please impart your knowledge on us.
Hey, thanks, Diva. I appreciate it very much. Hopefully, I won't go over too much of what you just said and live up to a little bit of it. And so I have a little bit of a presentation that I'll show, and this is not going to be a graduate degree in how to design life insurance policies, because really it's not very hard, and more importantly, it's a very personal thing. So it's, in the end, I talk with families one-on-one, go through a couple of meetings to actually design something that fits like a glove for their situation. It's similar to other people's, but the numbers are all totally different. And so if I show a lot of numbers today, I guarantee you that it will alienate somebody who was looking for bigger or somebody that was looking for smaller. And so this would be a little bit more basic. And I want to show, most importantly, where this fits and how you should think of it in your financial life. And then in other get-togethers, Deepa has already promised me that we'll talk about more about growing wealth and how to use this as you walk through life, right? And my role as a wealth strategist, I see as someone who is going to help shepherd my families or my clients to hopefully miss a bunch of potholes out there and risks that can take away all of their wealth and allow them to achieve agency, which is the financial dream, in my opinion. It's a word that's not used very often, but I use it all the time on my podcast. So let me share a screen and I'll go over a little bit of it. Does that work?
Oh, definitely. And you guys, full disclosure, Gary is my wealth strategist too, and I work with Gary, and he's amazing. So,
thanks for sharing that.
Thank you.
So I call it infinite banking. My friend, mentor, and business partner, Patrick Donahoe at Paradigm Life, got his shirt on today. He calls it a wealth maximization account. So you'll see that term in here as well. It's all simply high cash value whole life insurance. And the infinite symbol came from the idea that instead of collecting up dollars and then spending them on an investment or an expense, instead you hold on to your money and access the equity in it or access the value of it without actually giving it away, right? And so you're enabling that compounded long-term return. That's where the title comes from. And so I have a podcast, and my podcast is called Gary's Gulch, which is a very, very odd name. It's at least got a lot of color. The term comes from a book that I highly recommend anybody who wants to grow wealth and understand what's happening economically in our world. I recommend you go get this fiction book. It's probably the first time somebody has recommended a fiction book in a while to you, but it's called Atlas Shrugged, and it's by an author from the 50s and 60s. Her name is Ayn Rand. She was an immigrant from communist China and devoted her life to convincing Americans not to go down the road of socialism. And in there was a group of people who were pushing back on the entitlement world and the socialism and all of that. And they were trying to teach others and to be able to continue running their own businesses in a way in which they maintained control of their own lives. And that's really inspiring to me, and I think really badly needed in our country, because in Gary's perfect world, what our founding fathers put in place 250 plus years ago is that, I guess it wasn't plus, it's almost 250 years ago. They put in place a system that was revolutionary around the globe. And the idea was that if you work hard and build something, you get to keep it. And that was amazing. And when people were set up in their lives to do that, running their own businesses, creating their own goods that they could trade for somebody else's goods, it really worked out pretty well. When we got kind of down this industrial revolution and started being all W-2 employees, it didn't work as well anymore. And we've been continually moving away and away and away from having control of our own lives, and more into like depending on the state to provide protection and funding and that kind of stuff. And so that's what my podcast is all about. And it's what I do in my day job, is help people put the building blocks in place so that they have control over their own lives. And it's what I'm passionate about. It's why I left the military early to go do something like that. And I have a few books that I would gladly offer to your audience. A couple of them I've participated in. One's not even pictured here. And then there's this one called Heads I Win, Tails You Lose by, again, my mentor and friend, Patrick Donahoe. And I pull a couple of concepts out of his book when we go through this. Deepa already went over this. I had one topic that I wanted to talk about, though, and that is why I love real estate so much. So that cute little guy with hair on the top left was me. And I grew up on a farm in the 70s and early 80s in Illinois, dairy farm, pretty hard place. And in fact, we tried everything we could think of. We got rid of dairy cattle and tried everything else, ran little businesses, because early 80s is a time in history that rhymes with today. And it was very high interest rates, high inflation. People had, gas lines, and everything was super expensive. And we were struggling, especially where I grew up in Illinois. We ended up losing our farm because we did not have fixed interest rate loans on the farm. And I saw neighbors, one on one side was a third generation farm, had their farm paid off years ago, and they did just fine. It's almost like they had gold in their hands and it just kind of went up in value, but they had the same thing after the inflation that they had before. We were wiped out with variable interest rate loans on the wrong side of the table from the Federal Reserve. But then there were people who had fixed interest rate loans, and they did better than the neighbor on the other side. They got absolutely wealthy because they had very small amounts of money protected from inflation into an asset that went way up in price. And that's what I teach people to do today with real estate. It's really the same thing. I would teach people how to do it with gold if they could borrow money to buy the gold with, but you can't do that, right? And no one rents it from you. So real estate has some nice advantages beyond that. But my core of why I like real estate and life insurance goes right back to when I was a young guy. And I wanted to get out of Illinois. And the reason I went off and chased a W-2 job was kind of twofold. On day one is because I had no money to go to college, and these guys let me do it for free. And they also offered a nice W-2 job that was somewhat unique. And I chased that job and had an incredible life on fast attack nuclear submarines, and had as Deepa mentioned, the pleasure of commanding the USS Tucson. This is also an interesting time in life, though, because this was like 2011 when I was leaving the command of that ship. And I spent the entire most recent Great Recession in command of a submarine, paying no attention to where my money was at the time, which was in stocks, bonds, mutual funds, and 401ks and things. And I lost half my family's wealth, and no one told me. No one said you should watch out and pay attention. And I wasn't doing that. I was under the ocean in a submarine in the Pacific. And so what I learned from that was I need more control. And so I devoted my life to studying business, how generational wealth occurs around the globe throughout history, investing, and real estate. And that led me down this rabbit hole to find this thing called infinite banking. And what I was trying to do when I found it was fund this real estate without my own money being at risk of loss, and to be able to leverage it as much as I could to get as much real estate as possible, going back to my childhood, to protect my family as well as I possibly could from inflation. So I was desperately convinced that in 2013, when we started quantitative easing 10 years ago now, we were going to have massive inflation. And we didn't at that time. I mean, we got it since, but we didn't have it then. And so I was a little early to the party, and they actually surprised me how well they could, kind of manage the interest rates by printing still. So That's what drives me. And that's why I think the way I think. And, anytime you're around somebody, it's important to understand what their baggage is. And I have plenty of it. But it pushes me in the direction that I think is beneficial for real estate investors. So what is this infinite banking thing anyway? Really it's a cash management system. I could have came up with a much, sexier, like, hidden in smoke and mirrors version that you will hear very often. But it's just a more efficient place to store and grow your family's wealth instead of a savings or checking account or a safe at your house. It's a foundation for your family's wealth or your business's wealth. It's not the investment itself. I mean, you could use it as an investment, just like you could invest in CDs as your plan to grow wealth, right? It's slow. It's pretty certain. This is absolutely certain, but I wouldn't call it personally an investment. And I would say that it's just a really efficient savings vehicle. So in his book that I mentioned here earlier, Patrick Donohoe has a great analogy that he adapted from Abraham Maslow. And Maslow was talking about hierarchy of needs, if you've ever come across that. And he was using this Egyptian pyramid as an example of something that has stood for thousands of years, a very stable human man-made structure. Yet the reason that it stood forever like that is because they didn't cut any corners. They took the time to fill in the bricks along the way and not skip this level to get up here. And so he talked about food, shelter, and clothing, basic needs, and then moving up to community involvement and on your way up to the goal for him. So Patrick used the same analogy to talk about our relationship with our money. And it was pivotal for me when he was talking to me about it nearly 10 years ago. And I talk to every client about it now because I just realized the impact it had. And I also learned in feedback from them that this is impactful for most of my clients. It does really two things. It gets us to think differently about what we've been told for decades about our money. And it also is a great way for me to very simply, and something that will stick with you because it's a picture, very simply to show you and reiterate, where does infinite banking fit in your financial world? So we talk about, instead of, community involvement and stuff, we're talking about your relationship with your money, and specifically, how much control do you have over your money? Who's got it? What are they doing with it? When are they going to give it back to you? And is it going to bring back any friends with it? Like, that's really what's important to know about your money. And if you have a ton of control, then by definition, you're very, very low in this pyramid, which means that your risk is super low, because risk and control are opposites. To just be really silly about it, if you put you dig a bunker underneath your house and you put all your money in it in a safe and hire really successful special forces guys to watch your money, that's really low in this risk pyramid, right? And you have a lot of control over the money. But instead, you take it out of there and say, that was boring. And some guy drives up and says, if you give it to me, I'll make you millions. And you hand it to him. Now you're up here. Right. So there's everything that we do in life is somewhere in between those two kind of silly examples. And so the top three levels are what we call investments. And I just kind of break it into four total, just so it's much simpler. And I have personally added, the description of direct investing here, indirect, and then speculation. And to me, I'm a pretty simple guy. The word investment to me means I took my money and put it at risk of losing it for the opportunity to grow it faster. But it is at risk of loss. That's that key point. It's not sitting in the bottom level down there, tier one. And then the definition of savings is it is 100% not at risk. We can talk about whether it grows or whether it's being taxed or not. And how hard it is to get your hands on it. But the most important thing is that it is 100% not at risk. And so I add to it that it needs to be safe, liquid, and guaranteed so that you can get your hands on it pretty quickly too, right? Because your emergency fund is sitting in this location. Reserves for your businesses and your properties is sitting in this location. And so to summarize again, there are investments in these top three levels, and then there's a foundational savings asset that's down below them. That's really, its job is to support them. To put some pictures to it, directly investing in ourselves, our own businesses, our own real estate, those are things that we're making the decisions about, and we know a lot about. You're constantly involved with those things. And as a result, our risk is low. As you move up, you might have heard of syndications, right? A lot of your listeners have, obviously, investing in somebody else's business. So in that case, you've entered this kind of counterparty risk of the other person. Like they may not know what they're doing, or they may be unethical, and that would be dangerous, right? And I've certainly I've lost money in both of those situations for those reasons, and I continue to learn. And so I help clients as a wealth strategist be more successful in this arena up here. Speculation, I put the markets there because most people are like me in how they deal with the markets. And that is, we hand money off to some manager and he puts it into some random basket of companies. And none of us are going to the board meetings of these companies or reading the 500-page PPM, or not PPMs, but corporate reports, right? And so we're just not doing the due diligence. And therefore our risk is high because we haven't done the due diligence with it. But down here, obviously, you get all kinds of information about tenants and toilets and about your own business and what your boss thinks of you, right? So we have all that feedback. But underlying all of this is actually my day job, which is kind of what today's topic is about. And that's high cash value whole life insurance. What is the thing that makes this successful long term? And so, as I mentioned, Patrick calls it a wealth maximization account, and that's his job: maximize your family's wealth. And the way it does that is that it provides certainty so that you will go out there and go after uncertainty. That seems like an oxymoron. But what I'm talking about is I start businesses. I invest in other people's syndications. I may even be a venture capitalist and put money in a place where there's an 80% chance I never see it again. But what gives me the confidence to go do that, the certainty to go do that? It's having a bunch of money in a location where it's safe, liquid, and guaranteed. Whereas if I lose that money, I'm okay. If I needed that money because an emergency came up, I'm okay because I have the money elsewhere, right? So this kind of gives you wings. Red Bull gives you wings. Wealth maximization accounts give you wings, right? It allows you to go seek uncertainty. And it also it's protecting the number one asset out there, which is the human, right? That is you and or for your family, you represent the most important asset out there. And so it provides the protection over that. And so once you've locked down the emergency money and the reserves for the businesses and properties, then you have this extra money, opportunity money, I call it. And you can access that opportunity money, put it to work in these assets, get cash flow back from them, and continue to cycle through in that infinite cycle that gives it its nickname of infinite banking. And so my role is to help you first identify what does your hierarchy of wealth look like, where are the vulnerabilities, help set up a really strong foundation. Maybe if you already have one, just reposition where the money's growing so that it's growing at 5% with no tax and providing life insurance as opposed to being taxed at a very low rate. So that's the big picture part. And then we walk it out, right? And so one of the most important things, another acronym maybe, is that you should always look at where you're going to put your next dollar and ask, is it the best place for my money, right? And do I have enough, what I say, do I have a clue? Does my money have a clue? Do I have control over it? Is it liquid? Can I use it for when I want to? And is it building equity, right? And if you can always position your money in those locations, then you are on a very, very good path. So I kind of run that through as a lesson and kind of a filter before I use my money. So there are some out there that you will come across that are very famous talk show kind of entertainers, and they will say that, hey, credit is bad, leverage is bad, and you should pay for everything with cash, right? Cut up your credit cards, do all that kind of thing, and they're right. When debt is working against you, the volume of interest that starts to accrue can bankrupt people. It is a powerful asset when it works for a long period of time against you. And so they give the advice that you do only cash. And that is good advice for somebody who is addicted to consumer credit. But there's a graduate course. And I'm going to make the assumption that people who are listening to this podcast have taken the graduate course or are ready for the graduate course. And they've solved this first level course. And that graduate course is, compounding interest is powerful. And if you get it working for you, it's just as powerful as when it's working against you. So used prudently with the right kinds of cash flowing assets, your money can work for you in the background, just like it's working against you when you're paying somebody else high interest credit. And so the graduate course is don't keep spending your money on investments and expenses, major family expenses. Instead, you can borrow against the asset and let it compound tax-free in the background. So that's the big picture with that asset. Here's an example of saving $1,000 a month in a location that grows at 5 to 6% a year, and you don't get taxed on it, and never taking it back out. So I was at the 20-year point reading some material on this topic and wondering, actually, I was reading Einstein's biography, and he was talking about compounding numbers, and I was trying to wonder, like, I've been saving for 20 plus years. Why is my money not up here and growing like this crazy, really exciting level? And what I realized was that I had saved for my first house, and that I had saved 5 years for my first investment and then spent it, and then started saving again for the next investment. And I was over here and I had saved kind of for 20 years. At least I had done the action of saving money, but I had not actually, I didn't have those dollars that I started with, 20 years ago. I had saved for 5 years, 4 times in a row, and started over. And so I was 5 years down the compound curve, not 20 years down the compound curve. And so now I teach people how to keep the money there and grow and still borrow against it and access it and repay it, borrow and repay. And so if, in a little bit more of a visual, you can build up money in your account or shift it from a savings account where it's currently sitting. And then you can use it to buy what Robert Kiyosaki calls doodads, right? And you would otherwise just spend the money and dump it out of your checking account. And so the money was up here, but now the amount liquid still is down here because you used it. You borrowed against the policy to make this investment. And then instead of using the money to fill up your checking account again, you use it to pay back that loan. And once you've paid back the loan, you'll find out that my money is no longer here, it's up higher, right? So this is that stair-step picture we just looked at in just a little bit different form. What I like to help people do, though, is use a loan against your asset to buy something that cash flows. And the reason is because now you have this ready-made thing to pay back down the loan. And so I love to help people start this way. And then once you have massive cash flow in your life, then you can use it for these kinds of things as well. So this is an example of, it's pretty close to my very first investment that I got in 2011, a fourplex in San Antonio, Texas. I needed $50,000 as a down payment. And I had a choice. I could either use my own cash and give up what it would have done for me, or I could borrow. And when I told my friends that I was going to borrow the down payment for this property at 6% for 25 years, they very quickly told me that that's $47,000 in interest. That's as much as you paid in principal. And that typically gets you advice like pay your house off in 15 years or pay cash for everything, right? And the reason is because they don't ask the question. They don't ask themselves, true, I have to pay some interest. And it sounds like a lot because that's a long period of time. But what could I do with my money if I didn't put it in, lock it up in that investment, right? And it turns out that 50,000 growing at that same rate with no taxes, where the 50K turns into 52K and then 57K, right? Over that 25 years, it becomes 215. And so to say that differently, same interest rates, but because I didn't dump my account and I allowed it to continue to grow that whole time, I earned 165, not 47. And so this is just a very quick snapshot example about why do I borrow money to make investments and let mine sit there and compound over my lifetime. So hopefully that kind of makes a little bit of sense. So there are some keys. I started off saying this isn't that hard. It's not rocket science for sure. There's a few things you really do have to get right. First of all, you have to use whole life insurance. There are many people who will talk to you about a thing called universal life, or IUL, indexed universal life, is pretty popular today. They have been through massive lawsuits. They have not performed well for people, especially as individuals age, because it's really it's really a term insurance policy with some cash value savings stacked on top. And there's no control that you have over rising fees and cost of insurance. And you can actually break the policy to cause it to default by borrowing too heavily early. So it's really not well positioned to be a big old work truck to carry your money around for you and use frequently. After that, though, you just have to add a couple of features. One that's called paid up additions, where you overfund it, and then maybe blend in some other features that allow it to really be optimized. But that's really it. You need to work with somebody who knows what they're doing and have it structured correctly. And then, have enough access to it to be able to use it for what you want it to be used for. Here's a quick example of what I just said in picture form. There's 3 features. You start with whole life insurance. You minimize how much that goes in that direction. And you minimize it by adding 2 features to it. One of them is called paid up additions, the one I've drawn in green here. You can kind of think of it as the cash part. Here I show only like 2/3 of the money going there. I typically today put about 85 or 90% of the money in that direction by adding a 3rd feature to this. But just this one move right here is going to take something that was designed to be focused on life insurance death benefit and get it more focused on something that's liquid and flexible on day one on contributions. So you can decide how much to put in future years, and whatever you put in this section up here is liquid and available for you to use. So I think I was watching the time and got us pretty close to about 20 minutes to the hour. And I wanted to leave time, Deepa, for any questions or anything that you feel like would be helpful or beneficial. I guess maybe I would just say one more thing. Sometimes I get asked, like, what size should I, or what's the right size, or what's the minimum I can get started with? And that a little bit has to do with your age, but not a lot. It is, I just came back from Las Vegas doing a mastermind, so I have Vegas in my mind. And I remember seeing a bunch of poker tables. And the only difference in the poker tables was that one you had to pay like $5 to play, and another one was like $1,000. And then there was this one behind this white curtain that they were like, if you need to know how much the minimum is, don't go behind the curtain. But the rules of the game were no different. The odds were the same, right? It was just you were playing at a different level. And that's what happens when you age. If you are healthy, there's not much difference in performance from a 20-year-old and a 70-year-old. There's a little, but there's not much. The difference is that you just have to play at a much higher level. You have to have larger contributions. And so it kind of depends on your age and a little bit on your health. But basically, or generically speaking, if you're able to save 10% of your income, we can design a policy of the size that would work for you. If you're not saving 10% of your income, I can maybe help you get there, or we can just maybe say, let's get back together when you have developed more of a kind of a savings habit. So the size, really not that relevant. Many people start off very small and then just grow as their wealth grows with them. Cool. Right. So I'll stop sharing there and look for a little feedback.
Okay, no, thank you. That was a great introduction, Gary. I've got a couple of questions. Okay. I get usually asked about you mentioned that, it's also protecting the person. We are breadwinners for now with young children. And does that policy have any occupational insurance, like for surgeons? Can they insure their future earnings? Is that a thing, or that's something completely different?
So they don't directly have disability insurance coverage. Okay. So I would just use a separate policy personally. Some of them have small riders like that. They do have something, and sometimes people will use it for that purpose. So it has, you can put on there a feature that's called waiver of premium for disability. And really what that means is if you were to become disabled, they would pay the insurance premiums for you. And so if you had a big old policy, let's say that you're putting, and let's say you're a surgeon and you're putting $200,000 a year into a policy. Well, they would pay that $200,000 premium for you if you were disabled. So you could kind of think of it that way, as
the income,
the fact that they're paying it into your policy and then you can go access it to live on. So you could think of it that way, but it's not purely disability coverage, like it's paying 60% of your income to you.
Got it. Thank you. And you mentioned something about indexed universal life. And can you talk a little bit about how it's different from what we're talking about, infinite banking? Sure.
So brief little history. Whole life insurance came out in the early 1800s in America. And it has been around the globe for, well, it depends on how you count, but probably 600 years. And like I said, early 1800s in America, there were whole life insurance policies on people who were fighting the Revolutionary War. The Civil War, not the Revolutionary War.
I got it.
And so it goes way back. And these companies that we work with all date back to those years and have been successful and profitable that whole time. Paying out profits to their customers. I can't even imagine what it would have been like to go out to the mailbox in the Great Depression, get 4 pieces of mail from your bank that your account is gone and that the bank is dissolved, and a piece of mail from the insurance policy which has a dividend check in it because they're profitable. Like all the banks are failing and they're profitable.
Right.
And so that's whole life insurance. Been around a very, very long time. People have aggressively been using it as an infinite banking kind of vehicle for probably 50 years.
Okay.
And so around the time they started using whole life insurance for that, and when I say aggressively for banking, I mean that you were able to start putting features on it that allowed you to accentuate the cash side of it. So,
Got it.
and in the early 70s, again, we were very high interest rates, especially late 70s, early 80s. And so you could get 10% in a CD. I mean, you could get 10 or 12% in a life insurance policy at the time as well. But they were looking for very, people got kind of drunk on really high interest rates and really wanted only high performing assets.
Mm.
And so the insurance industry, to try to compete there, created something called universal life insurance. And they allowed you to monkey with the mechanics inside the policy. So you could decide not to pay premiums for a while. You could pay less than was kind of what's called a target premium. And you could put your money in the markets that maybe the market would make the money for you to pay the premiums for you. And so they've tried a few different versions over the years since it came out in the early 80s, late 70s. And each version has resulted in class action lawsuits, and then it went away. The current version is index universal life insurance.
Right.
You can still get variable. You can still get just normal universal life insurance. They're just not very popular. And as you would expect, the class action lawsuits are out there for index universal life insurance. And the whole thing is that they're sold with the idea that you can't lose money, like you can't lose money in whole life insurance. And there's caveats that, like you'll hear with index universal life insurance, you can't, because it's indexed to the markets and not in the markets, you can't lose money based on the market, on market losses alone. But that last part of the phrase is often left off. And what is happening is that if you're in a period where the market is negative or zero, your indexing performance is zero, which is good. You're not negative. But then there's cost of insurance, fees of the company, and your account value is absolutely going to go down in a year in which the dividend did not boost up and cover all those costs. And so as you age, then the underlying cost so this is what term insurance looks like as you get in your 70s and 80s, right? And typically there's not enough cash value in there to grow and cover the cost of insurance in that case. So the bottom line is that the reason we do whole life insurance is that you can't break it by borrowing against it. The fees can never go up. The death benefit will be there until you're 121 years old. And there's a guaranteed minimum increase in your cash value every year. So not only are you guaranteed never to lose the cash value, but it's guaranteed to go up every year. And then on top of that is the dividend that adds to it, that has been paid since the 1800s.
Right.
So if it's going to be a foundational asset, safe, liquid, guaranteed are the requirements of that level, then it needs to be safe, liquid, and guaranteed. And I can't do any of those with a product that has the letter U inside it, universal life insurance. Now, it's not sold that way by most advisors. Most advisors will say you have your cake and eat it too. This can be life insurance and it can be an investment.
Right.
All right. And I don't know if when I was a kid, there was this car called the El Camino and the Grand Torino. No, that was a different one. But the Chevrolet and Ford both had one, and it was a car on the front and a truck in the back. And it was horrible about both of them. And so universal life insurance is that. It is not a great investment, and it is not a great life insurance policy because you can't count on it to do either feature well.
Oh my goodness, that's amazing. That's a great comparison. Thanks, Gary. One last question from my side.
Okay.
You talked about clue, having control, liquid, use, and can you talk about maybe a couple of investments which will give us the clue or give our money the clue?
Yeah, well, so I just start with those kind of lower tiers. And so real estate, so it's obviously building equity. If you directly own the asset or you are very close to this indicator so that, I know where you live and I know, how to contact you and I know you to be an ethical person. And I also know where the asset is, right? So when I buy shares of a real estate investment trust, I don't get the addresses, but I can't go check it out to make sure that it's in a good neighborhood. But I can do that. And so having something in tier 2 or tier 3, tier 2 being you directly own it. I mean, you have a ton of control. Now, in that case, your money may not be liquid, but if you get a relationship with a banker who recognizes the value of the asset, then you can borrow against it, right? So you can set it up in a situation where you can make it liquid. Or and then what was the other one? Use, right? Do I have use of it? Well, yeah, you have use of your money. Certainly in life insurance, you have use of your money. And if you can access it in the property, you have use of it. So, that's how I think about, making sure that my money and my assets do as much of that as I can. Like when I was talking about the clue, really later on in that presentation, I say, well, if we're going to save our money in the foundation, which ones give me a clue? Which one gives me control, liquidity, use, and access of my money? For example, a CD it's not really liquid, right? I do have control, but I give up a lot of the growth if I actually go pull the money.
Right.
Savings account has control, liquidity, and use, but it doesn't grow equity, right? And so each one of those kind of passes a little bit.
Right.
In my opinion, whole life insurance passes with flying colors on all four, assuming it's designed for high cash value, so you have use of it early.
Right. Right. Got it. What percentage would be the cash value? I know the listeners would want to know this.
Yeah. So let's think of a policy that you put $10,000 a year into,
okay.
And it could be $100,000 a year. But so at $10,000 a year, at the end of the first year, you've committed $10,000, and you would have access to, I'm just going to round off here and say 8,000 of the 10,000. The other 2 is there and is growing in the background, but they don't give you access to 100% because they are growing that and using some of the profit from it to overcome their startup costs slowly over time. So then the second year, you've got 20 in, and now you've got access to maybe 85% or 17,000, right? And then let's go all the way out to year 5. And now we've got 50,000 in there contributed, and you'd have access to right at that 50,000. So you start off at about 80%, then 85, 90, 95, 100%. You go 19 years down the road, you got 200%, right? So it's a snowball that starts rolling, but it is my goal to help people get 75, 80, maybe a little more percent access to the money on day one.
That's really good. I mean, if the money's sitting in the savings account, it's really not doing anything. And it doesn't have death benefit, right?
Yeah, so it's a super easy thing to talk about in year 5. If you're in year 2 trying to explain it to your friend and you're like, look, I put more in than I have access to, like you need to have a longer term perspective. For sure.
Right.
Yeah.
Well, thank you so much. And
it was my pleasure.
How is the best way, if anybody's interested in getting a quote from you, how can they contact you?
Sure. So I tried to make it simple. My good friend, Aaron Chapman, has accused me of being a narcissist, but I tried to make it simple. So it's Gary at GaryPinkerton.com. That's about as simple as I can make it.
Oh, perfect.
But also, reach out to my podcast, Gary's Gulch. You can, hear my thoughts and my recommendations on investments and things like that there. But yeah, Gary at GaryPinkerton.com is the easiest way to find me.
Perfect. Gary, thank you so much for being on the show and sharing your knowledge. And this is amazing. Thank you.
I look forward to our next time together. Thanks, Stifa.